Hello and welcome back to another episode of the Crypto Byte, only from Market Rebellion. We've got some really interesting stuff to talk to you guys about today. The market is reaching a boiling point here, so we want to talk about some historic data, take a look at how Bitcoin has held up during similar points of market stress, and give you guys some actionable data as well. Talk about some things that we're doing, some ways that we're preparing for the next 1 to 3 months of price action. So without further ado, let's dive right into things.
Thanks, Monty. This ought to be the most actionable crypto show or podcast available. But first, let's start about macro bottom indicators, because a lot of the models that have been used quite successfully for the last 10 years, since Bitcoin's inception really, have been very effective at pointing out bottoms within these cycles. Now, I do think there's an argument to be made why things actually might be different this time around, given the current state of the S&P, everything that's going on in Europe, and then obviously the bank runs that we've seen in China very recently. So things still do appear quite bleak, but nevertheless, let's get into some of these bottom indicators. So first one I wanted to reference is an inversion of the pi cycle top, which is actually called Bitcoin's tops 3 times in the last decade to about 3 days. This is just the same model but inverted, and as you can see, it called a really nice bottom in 2015, then once again in 2018, and right now we're actually getting one of the first bottom signals from this particular model in quite some time. So maybe we lead to some type of reaction rally following such depressed price action, but still, I think it's going to be much harder this time around to take these models at face value, considering the macro backdrop is so different in what we've seen over the past 10 years.
Absolutely. And one thing that we like to do, and analysts in general like to do, is look to traditional equities to kind of get a understanding of where Bitcoin may go. You know, CJ, one thing that is kind of tough to do is kind of actually get the proper valuation of Bitcoin. I know one thing that you have looked at recently is kind of a comparison between Bitcoin and the performance of Amazon, and how we maybe use the past performance of Amazon as a future indication of Bitcoin's price action?
Yeah, I mean, I think this all comes down to respecting market cycles and many things that we've seen throughout history. So, for instance, if we take a look at previous cycles and what we've seen with Amazon, very simply, if you look at the state right now and where it's at, there we go. It looks like a pretty bleak picture. You see on the left-hand side there Amazon from 2000 to 2004, and you see Bitcoin on the right side and what we've experienced very recently. This is both a 2-week chart, but if we're going to go through a full-on bubble pop market cycle, and we should go down to 12 or 14K in Bitcoin, we would really follow what we've seen historically in an asset like Amazon in the early 2000s. I think there's a reasonable argument to be made that these assets are kind of in a similar place. If this is the future for what Bitcoin has in the next couple months, then we definitely want to discuss some strategies on how to capitalize on that. But you want to talk a lot about traditional equities as well as Bitcoin and how they can create kind of a synergy and play off one another. So would you like to speak to that?
It's definitely important to take a look at Bitcoin in context of the traditional equity markets, because if we take a look at Bitcoin and you think about what Bitcoin is, it really is a byproduct of the last major financial crisis we had. Bitcoin was created in 2008, right after the major economic collapse, when banks were bailed out all across the United States, and there really was uncertainty on a scale to which we haven't seen since. So now that Bitcoin's pulling back in conjunction with traditional equities, and we're getting a lot of these macro bottom signals, like you mentioned, CJ, pi cycle top, 200-week moving average, and more, all flashing bottom signs, I think it's worth taking a look at the NASDAQ and seeing where that has been during similar instances of Bitcoin retesting that moving average. So here's a chart of the NASDAQ, and as you can see, during Bitcoin's history, there's basically been 3 major retests of the 200-week moving average, and those have all coincided with downturns in the NASDAQ as well. So taking a look at Bitcoin here, first on August 31st of 2015, that was a retest of the 200-week moving average. That coincided with a pullback in the NASDAQ as well. Not quite all the way down to the moving average, but still this level was not breached. Then if we look at the next instance of a retest, That's all the way in December of 2018, and that coincided with a pullback in the equity markets as well. Not quite, to the moving average, but still a pretty significant pullback after an extended period of positive price action. Again, this is the weekly chart, so this was, a pretty significant correction following a period of very positive price action. And once it bounced, Bitcoin did as well. And then obviously, moving on to the most recent, which was COVID, March of 2020, again, there was some relief found in the equity markets that also allowed Bitcoin to bounce from that critical 200-week moving average. So now Bitcoin is, for the first time in its history, going below that 200-week moving average, and that's also happening with a weak equity market. So for me, what I really need to see is this level maintained in the NASDAQ and in the Qs. And if you look at, like I said, what we've seen historically, Bitcoin has never seen this sort of sell pressure coming from traditional equity markets during its brief existence. So this is really its first major test. And if the NASDAQ and the S&P and the Qs lose these critical levels like the 200-week moving average, I think that is going to be the ultimate stress test for Bitcoin. And for those reasons, I don't necessarily think the lows are in. At the beginning of the show, CJ, when you talked about those macro bottom indicators, you mentioned that this time may be different. I think this will be the main thing to watch. The NASDAQ and traditional equity markets, can they maintain the 200-week moving average, or is that level breached? Because if it is, we're entering uncharted territory for Bitcoin, and I think you really need to prepare yourself for that scenario. So, like we keep saying, traditional equity markets, super important gauge of just, health of the markets and speculative tolerance of investors. So we're going to keep watching that going forward. But now that we've talked about that, I want to dive into some actionable trades, some things that we'll be doing over the next 1 to 3 months, because I think there is still a lot of opportunity, even if it is to the downside. So let's talk about that. But before we do, we're going to take a quick break. We'll be right back.
Want more from CJ and Monte? How about 2 new trade ideas per week, global online chat, over 35 video lessons for beginners and experts, proprietary charting software, and so much more. Get in the crypto room today. Get started for just $7.
You mentioned how important the equity market is for crypto. I could not agree more. And the thing that's quite interesting that also kind of worries me is that there's this predominant narrative or kind of attitude within longer term crypto investors or even newer crypto investors that all right, next cycle, next Bitcoin halving, we're always going to make a new high. And I think you got to see that conviction tested a little bit. And the way that you test it is you go below these levels that have held virtually for the past 10 years, whether it's the 200-week moving average, whether it's the pi cycle bottom, whether it's the rainbow chart. I mean, there's tons of macro indicators that are all hinting for that. So if we are to follow, what Amazon did early on, what are the optimal opportunities to take advantage if we're just doing trend following strategies to the downside? Like we talked about weeks ago on this show, GMT was one of the assets that we had liked to short. I still think that valuation has to come off a little bit. But ultimately, it's kind of the same short thesis. You're looking for the assets that are obviously the weakest and have very low network activity. But more specifically, you're looking for a supply schedule that's continually increasing. And the playbook for many VCs is to release these tokens, hold a very large amount for themselves, and then hedge with perps on places like FTX or wherever. So basically, you're taking the same trade as those VCs and hedging with perps, but you're doing it in vehicles that I think are extraordinarily weak. So the first one I want to talk about is Looks Rare. This is an NFT marketplace that released a token, and the tokenomics I just think are very poor. Very similar to GMT in the sense that you're going to see a lot more new tokens hit the market and create sell pressure, and you have to ask, where is that sell pressure going to be absorbed from if we're still in very risk-off market dynamics? If you see the supply release and the chart that we can take a look at, if you look at day 180, you see a massive amount of new tokens hitting the market and will continue to hit the market in the next few months. That was last week, was day 180. So, I think that looks is definitely one that's a pretty optimal target for short plays. I would just look for continuation to the bottom of its range right now. And, if you want to ask yourself, like, okay, well, where am I wrong? Where's my point of invalidation on a lot of these shorts? For me, it has to do with Bitcoin, and specifically on the weekly chart. If we get above that seven smooth moving average, where you can see that white moving average on my chart behind me, then the short bet is off. Maybe you play a reaction rally up to like 25 or 30,000, but the short trades, in my opinion, at that point need to be closed. But if that doesn't happen and you just do trend following continuation, I think the opportunity still is to the downside, even though Bitcoin's already down 70%. I mean, so last thing I'll say is that, when sizing positions, especially, just speaking from my own experience, like, you want the position size to be in accordance with your level of confidence within the trend. And we're already down like 70%. So my confidence interval is not super high, but I still want to bet on the continuation of some of these plays. How about you, Monty? How are you positioning yourself?
Yeah, like you, I am still positioning myself to the downside. If you guys didn't catch our last episode of the Crypto Byte, we talked a lot about unlock schedules and assets that look fundamentally weak. Since then, they've drawn down a lot, but they're still suffering from the same problems that they were during our last episode of the Crypto Byte. So I think looks rare is a great example of an asset that looks fundamentally weak. But to your last point, CJ, one thing that's going to be super important in the next couple of weeks to months is protecting yourself from short covering rallies and just interim relief rallies. Because when you're playing the market to the downside, there is a lot of risk. Like you pointed out, I mean, Bitcoin is already 85% off its all-time highs. The short trade is going to get crowded inevitably, especially with people, the most common level I'm seeing on Twitter and amongst other analysts is 10K. Lots of people looking for that 10K Bitcoin level to be hit eventually. And whenever you have a target that a lot of people are looking at, a kind of an overcrowded trade, that can ultimately be punished. And I think that looking, to what we've seen in just the last couple of weeks, we've seen some incredible short covering rallies. So like a great example is GMT, right? We identified this as a fundamentally weak asset. I still think it has a lot of downside potential. That being said, look at this chart. This thing has done some, ridiculous moves into market weakness for no good reason other than shorts covering their positions. And a lot of this came when the NASDAQ was performing well. Also, we had just last week some relative positive performance in the NASDAQ. Like I said, a slight relief rally, but still, that is when shorts get shaken out. So you can't just enter into a short trade passively and just sit there and be like, I'm going to ride this down, wait for the market to bottom and close it out. There will be volatility on the way down. That is one thing that we have seen historically and we can expect to see again here. And especially with those assets that are fundamentally weak, although they may have the most drawdown over the long term, in the interim, you'll see the most volatility in those assets because they are the most heavily shorted, and thus we see the most violent short squeeze in those assets. So, GMT, waves, even things like, Near Protocol, which suffer from similar things like you talked about with looks being unfavorable vesting schedules. All of these things see violent short covering rallies. So if you do want to play to the downside here, you need to be nimble, you need to actively manage your positions. And like you pointed out, CJ, be ready to cut your losses if Bitcoin does start to move, because I would expect that to take all the alts with it. So really that's kind of, the most important thing for me is I am trying to play the downside, but I'm doing it in a way that is reflective of kind of where we are in the current trend. And that is still 80% off, all-time highs. So proceeding with caution, but still think that there is lots of opportunity to the downside here.
Yeah, you definitely got to be careful about the short covering rallies. You cannot short support in a bear market like you can buy resistance in a breaking out, crypto market. So those same strategies that may have been successful in a bull market are not really applicable in a bear market. And these are like, run and gun 3x, 2x leverage type strategies for, kind of short-term run and gun. I'd say the ones that I feel most comfortable shorting into resistance levels are GMT, Looks, and Harmony One. Harmony One, it's a great consensus trade because it's like, the shorts, like you said, they ran it up 20%, and within the next couple of days, they just smashed it back down, and all that gain from shorts covering was virtually erased. So also, when you look at it fundamentally, the L1s, which have the least amount of activity within their networks right now, are Harmony One and Moonbeam, I believe, from Polkadot. So I think that's important, and I think that you're probably going to see just continued hopelessness and boredom and like a slow bleed. But you can't get caught on the other side of that short squeeze, because like there's no point in losing money in a bear market when you could just be in cash. But yeah, I mean, that's my strategy. I'm sure you'll take some of those as well, maybe, and we'll check back in about 4 weeks to see how things ultimately ended up.
Yeah, until then, we'll be hanging out in the crypto room. If you guys would like to join us, you can check it out at markrebellion.com/trycrypto. And please don't forget to like and subscribe. It definitely helps out the channel a lot. But that is all we got for today. Looking forward to seeing you guys soon. Take care and happy trading.